Opendoor just closed one of its toughest sessions in recent memory. The stock plunged 15% on Tuesday, dropping by $1.30 to finish the day at $7.08 per share. And to make matters worse, the selling didn't stop at the close. Pressure carried into the aftermarket. For long investors, for the open army, this is the kind of day that tests conviction, the kind of day that shakes the weaker hands, and the kind of day that forces you to zoom out and ask the bigger questions. What's really going on here? Who is selling? And what does it mean for the future? The first thing we have to acknowledge is that Tuesday's decline wasn't just random panic selling. There was a very specific trigger. It was revealed that Access Industries, a major institutional holder of Opendoor shares, sold roughly 12 million shares. When a position of that size gets dumped onto the market, the effect is brutal. It's a tidal wave of supply hitting demand. No matter how strong the conviction of retail holders, when that kind of volume gets unloaded, it drags the price down hard. That's what we saw on Tuesday. Now, some people may look at this and panic even more. They'll say, if Access is getting out, what do they know that we don't? But there's another way to interpret it, and I think it's actually more positive for long-term holders. Remember, Access Industries has been involved with Opendoor since the very early days. They were part of the story when the stock traded as low as 50 cents per share. In many ways, they were legacy holders. And like any legacy investor, there comes a time when they want to cash out, rebalance, or move on. Their selling doesn't necessarily reflect the future prospects of the company. It reflects their own positioning. And in fact, sometimes clearing out those older hands, those big players who may not be aligned with a new vision, actually create space for new conviction investors to step in. In that sense, Tuesday's pain might actually clear the decks for stronger ownership going forward. This brings us to the conversation around Eric Jackson. After Monday's drop, a lot of retail energy turned toward him. Some said his focus on another stock, BETR, distracted attention away from Opendoor and triggered selling pressure. But Tuesday's action vindicates Jackson to a large extent. The scale of the sell-off wasn't about retail chatter. It was about Access dumping 12 million shares. That's the real weight that pushed the stock down. Blaming Eric Jackson for that would be like blaming a single soldier for the outcome of a battle when a massive artillery strike was the real factor. Now, to be clear, Jackson is still an important voice in this story. He's been one of the loudest advocates for Opendoor, comparing it to GameStop but with real long-term fundamentals. He's the one who stood outside Drake's house to draw attention to the stock. But at the end of the day, he's also a hedge fund manager. He's going to look at multiple trades at once. That doesn't mean he's abandoning Opendoor. He's still long. It just means he's playing his role as an investor, not as a one-stock evangelist. What Tuesday showed us is that while retail sentiment can move the needle in the short term, the real gravity in the stock still comes from the institutions. And that's why the Access exit is so significant. On the short side, we also had a notable development. Martin Shkreli, one of the more vocal bears on Opendoor, announced that he has closed out his short position at around $8.90. His reasoning was simple: there are better short opportunities out there. That's an important point. It means that one of the most visible critics of the stock, someone who had been actively shorting it, has now stepped aside. For shareholders, that's a small but meaningful relief. Every short that covers reduces downward pressure. It doesn't mean the stock suddenly shoots back up, but it does mean that the bear camp just lost one of its loudest members. And remember, short interest in Opendoor is still high. Jane Street, Square Point, Simplex, Wall-E, all of these institutions are still short. But if Shkreli is moving on, it signals that the easy downside may already be behind us. Meanwhile, on the business front, there was a big reveal from Kaz Nejatian, Opendoor's new CEO. He confirmed that the new product they're preparing to launch next week is buyer-focused. That's a very important detail. Up until now, a lot of Opendoor's model has centered on sellers, people who want to unload their homes quickly. But the future growth of the platform depends on capturing the other side of the market as well. A buyer product means Opendoor can begin to serve customers on both ends of the transaction. That's how you build an ecosystem. That's how you expand margins. And that's how you transform from being seen as just an iBuyer to being seen as a full real estate platform. Kaz also mentioned that they're looking for testing markets for this product. That shows two things: speed and discipline. Speed, because he's not waiting a year to roll something out, he's moving fast and being transparent about it. Discipline, because he's not just blanketing the entire country. He's looking for test markets where they can refine the model, gather data, and then scale. That's the Shopify DNA coming through, and it's exactly the kind of leadership signal that long-term investors want to see. And let's not forget about Kaz's own alignment. There's been some chatter about his compensation package, and here's what we know: his upside is heavily tied to performance-based equity grants. Those grants vest in tranches tied to stock price targets, going all the way up to $33 per share. That means he doesn't just collect a fat salary no matter what happens. He has to deliver results, and the bigger his results, the bigger his payout. In other words, his incentives are directly aligned with shareholders. He wins if shareholders win. That's the kind of structure that gives investors confidence. Now, stepping back, let's think about the bigger picture catalysts still on the table. Number 1, the Federal Reserve has already cut rates once, and there's the expectation of more cuts this year. That's huge for a company like Opendoor, because housing is one of the most rate-sensitive sectors of the economy. Lower borrowing costs mean more affordable mortgages, more buyers entering the market, and more transaction volume. Every cut the Fed makes is a tailwind for Opendoor's business model. Number 2, the national rollout. Kaz has already accelerated Opendoor National to all lower 48 states. That gives the company reach, scale, and data. The more markets they're in, the more transactions they process, and the more accurate their pricing models become. That's the flywheel effect in action. Number 3, cultural reset. Kaz has mandated a return to office starting September 29th. This is about accountability, efficiency, and trimming the fat. Keith Rabois has said bluntly that the company is bloated, that maybe only 200 of the 1,400 employees are truly essential. Now, there hasn't been a formal layoff announcement yet, but the return-to-office policy is a forcing function. It will naturally thin the ranks, and what remains will be leaner and more aligned with the mission. Number 4, insider conviction. Don't forget that co-founder Eric Wu recently bought nearly $3 million worth of Opendoor stock at around $6.65. Insiders don't buy at that scale unless they believe the long-term story is intact. That's a strong signal, especially in the middle of volatility. So when you put it all together, here's what you get. Tuesday's plunge was real, it was painful, and it tested everyone's patience. But the reason behind it was clear: Access Industries sold 12 million shares. That's not the same as saying the company is broken. In fact, it may even be healthier without them in the mix. Meanwhile, one of the most vocal shorts has closed out his position. The CEO is aligned with shareholders through performance-based incentives. A buyer-focused product is about to be tested. The national rollout is done. The Fed is cutting rates. And insiders are buying. This doesn't mean the stock is going to rocket back to $20 overnight. Volatility will continue. There will be more red days. Shorts will still press their advantage. But the long-term reset is still intact. The catalysts are still ahead. And the leadership is still moving with speed. For the open army, the takeaway is simple: don't confuse a painful day with a broken story. Sometimes the hardest days are the ones that set the stage for the biggest comebacks. So as we close out Tuesday and look toward the rest of the week, remember this: conviction isn't tested when the stock is green. Conviction is tested when it's red. Access has left the battlefield. Shkreli has walked away. Kaz is pressing forward. And for long-term investors, the mission remains the same: hold the line, focus on execution, and let the catalysts play out.